Good afternoon, everyone, and welcome to EBW's first webinar of the year. I hope y'all are keeping warm and have begun to dig out from our snow or ice storm or whatever we call this. Or I don't know, maybe you said the heck with it and are hunkered down with a good book and a cup of hot chocolate. But either way, I'm really glad you're joining us today. I'm Howard Pressman, one of the partners here at EBW, and I'm really excited to introduce Brad Newman with one of our great partners, Alger. Some of you may recognize Brad as he has spoken with us before. But as we head into the uncertainties of 2026, or what I call following the white rabbit, if you're unsure what that means, I encourage you to read our 2025 year-end wrap-up. Brad will help us make sense of the many complex themes that are playing out in our economy right now. Brad is the Senior Vice President and Director of Market Strategy at Alger. He joined Alger in 2015 with 26 years of experience. Before joining Alger, he was a partner at Omega Advisors, where he managed investments in the consumer sector. He was a managing director at Glenview Capital and equity research associate analyst at Credit Suisse. Brad is also a certified financial analyst. So what that means is he's really smart. I'm gonna turn things over without further ado to Brad. If you have questions, you can go ahead and email those questions over to info@ebwllc.com. Again, that was info@ebwllc.com, and we'll make sure that we get those questions answered. So again, without further ado, I'll give you Brad.
Okay, thanks a lot. Can you hear me okay? And does the screen slide look okay?
You look good.
Great. Well, I'm going to give you an overview of how we think about the bull and the bear case for the economy and the stock market, kind of a macro overview. And I'm going to try to place it in kind of a longer term continuum of how to think about your investments and staying invested over time. And happy to take your questions throughout. We'll have a little poll question to get you involved, and I think you'll really enjoy it. You know, this is the year that America turns 250, and we're reminded of the remarkable history of progress this great country has made and how the pace of innovation continues to accelerate. You're going to hear the word accelerate from me many times because I do think that the pace of growth is getting faster and faster. You know, in the late 1700s and early 1800s, transformative advancements reshaped commerce and communications. But those innovations took generations to diffuse throughout society. They took, to reach half of the US households, the postal system, for example, took 267 years. Newspapers took 172 years to reach half of US households, and steamships took more than a century. But over time, the pace of innovation has increased. The internet and social media took just 14 and 9 years respectively to reach the majority of the country. And today, what we're living through, in my opinion, the greatest innovation of our lifetimes, artificial intelligence. Generative artificial intelligence reached half of households in just 3 years, a speed that dwarfs every prior general purpose technology by a lot. So, we said hundreds of years for postal system, newspapers, steamships, with decades for dishwashers, washing machines, household appliances, those kinds of things, 14 years for the internet, and just 3 years for generative AI. So that breathtaking acceleration underscores a defining feature of our era, and that's that innovation is compounding and adoption curves are compressing. In fact, we may see meaningfully faster growth in innovation in the coming years. Elon Musk recently proclaimed 2026 as the year of the singularity. What that means is it's when AI begins improving itself in a recursive fashion that causes it to explode well beyond human limitations. That scenario is supported by the creator of one of the most advanced generative AIs, that's Claude by Anthropic, with the head of Anthropic saying that AI is now writing 100% of his contributions to Claude, over 40,000 lines of code a month. So essentially we have software writing software, and with that, change becomes exponential. So I think the AI revolution is going to combine with economic policy to drive a business spending boom in America, and that's what I want to go over with you. So typically we think of the economy as driven by the consumer, right? I think most of us know the consumer is, more than two-thirds of the GDP. But there's a piece of the economy that's growing much faster than consumer spending, and in our view is primed to continue to grow faster and accelerate. And that's business spending. So in economics, we call it private, non-residential fixed investment. Private because it's not the government, non-residential because it's not consumers, it's business, and fixed investment because it's investment that produces a return over time. So this is essentially industrial renaissance or reindustrialization of America. And it's driven by the innovation that we just talked about on the one hand, and secondly, by economic policy. And there's kind of three legs of the stool of economic policy that's pushing forward this huge business spending boom. The first is trade policy. So we all know that the administration implemented tariffs in April of last year. That's incentivizing domestic investment as corporations seek to avoid those tariffs by producing in the United States. So they're building manufacturing facilities for pharmaceuticals, what I call manufacturing facilities for AI, which are essentially producing artificial intelligence tokens, which is a unit of intelligence. We'll talk more about that. So to avoid tariffs, you have to build in the U.S. So the trade policy is the first leg of the economic policy stool. The second one is fiscal policy, which combined with pro-business regulation is amplifying this momentum through generous tax incentives, including immediate expensing of equipment, manufacturing facilities, domestic R&D, and software. This was all part of the One Big Beautiful Bill that was passed in July 4th of last year. So trade policy, fiscal policy, and the third leg of the stool is monetary policy, which is very supportive. The Fed's lowered rates by 175 basis points over the past couple of years, and they're potentially going to decrease rates more this year. So lower borrowing costs, lower Fed policy means lower borrowing costs, and lowering borrowing costs means more business spending, better returns on that business spending. So what you're looking at here is this chart is U.S. private non-residential fixed investment. It's averaging about $4 trillion, a little over $4 trillion a year, about 14% of the economy, relative to the $30 trillion U.S. economy overall. As I mentioned, it's growing twice as fast as GDP, and it's driven by tech business spending, which is growing about 20%, so much, much faster. And what's amazing is that over the past 12 to 18 months, there's been $10 trillion of announced investments in the US. And so that won't all filter into business spending in any given year, but even if it gets spent over the next 5+ years, it still has the potential to vastly increase this business spending. So we think we're in the midst of an American business spending boom, a reindustrialization of America, an industrial renaissance, if you will, driven by innovation in AI on the one hand and economic policy on the other hand. So that's kind of the biggest picture stage that I can set for what's going to drive the economy going forward. But I want to drill down on that a little bit and get into AI. Before we do that, I think we can bring up a poll question. Great. Thank you. So I'll read it off. Relative to the internet-driven 1990s bull market, which I'm sure you'll have a lot of questions about how this is different or similar, where would you place today's AI-powered stock market? First choice is 2000, which means we're at or beyond the peak, because obviously the internet bull market peaked in March of 2000. Would you place today's AI-powered stock market in 1999, approaching the peak? Or would you put it at 1998, well before the peak? So make your selections, and then let's see what the wisdom of the crowd has to say. Can you bring up the results? All right, interesting. So kind of split, but most people think we're not quite yet at the peak. So that's three-quarters of folks think we're 98 or 99. Okay, so I will give you my view, which basically agrees with the audience view. This is one of my favorite charts. This chart shows the NASDAQ progression along two time frames. One, since the advent of Netscape in December 1994, that's the light blue line. And the second one is the NASDAQ currently since the introduction of ChatGPT in November 2022. So, as a refresher, Netscape was a big, it basically introduced the world to the World Wide Web because before Netscape, which was the first browser, the first graphical interface browser, you had to interact with the internet through text, and essentially no one was doing that beside, a few nerds. And so the Netscape allowed the masses to access the internet, and it ignited, as you can see in light blue, uh, technology bull market in equities. And we had very strong returns from December 94 all the way up through March of 2000. Now, I'd argue that ChatGPT was a Netscape-like moment for AI because before that, the average person couldn't interact with generative AI, couldn't ask questions and have it help you with whatever issues you're working on at home or at work. And since then, we've obviously had a strong equity market over the past few years, driven by this generative AI explosion. Interestingly, that in the 3 years since its introduction, the NASDAQ composite has surged 113% since ChatGPT, which is almost the exact same as how much the NASDAQ was up in the 3 years following the NASDAQ, following the world Netscape introduction of the World Wide Web back in December 1994 was up 112%. So it's following almost verbatim the same curve that it did in the 1990s. And so what that means is that we are potentially in, the internet build out timeframe analogy in early 1998. And there's several implications to us being in early 1998 if that is indeed the case. First, for an investor, the most important thing is that there might be much larger gains ahead because even though the returns were very strong in the 3 years following the introduction of Netscape, the NASDAQ went on to increase 220% through March of 2000. And 1998 itself was a 40% year. So if we're in something like 1998, you have the potential for strong returns here. And by the way, the Fed was cutting in 1998 like they may be cutting in 2026. But maybe more important for the big picture, I think, and economically, is that most of the internet was still very nascent in that many of the major technology giants responsible for a lot of the shareholder value creation tied to the web had not yet been founded in early 1998. For example, Google was founded in 1998, PayPal in 1998 as well. They hadn't come public. That wouldn't happen for several more years. Salesforce wasn't a company until 1999. Facebook was invented in 2004, Uber 2009, and Instagram 2010. So all of the huge companies that we know and love relative to the internet all came after those first 3 years subsequent to the launch of Netscape, which means that many of the companies that'll probably drive a lot of the value creation relative to generative AI haven't even been created yet. We don't know their names. So potentially early, still in the cycle, and potentially a lot of value creation left. And by the way, if you want to interject with questions, feel free. I want to just make a few other points about the bull market in addition to AI. We just mentioned Fed policy, and Fed policy is pretty important because it governs borrowing rates in the economy, which impacts overall economic activity. Lower borrowing rates means that consumers and businesses spend and invest more, and vice versa. And so when the Fed is lowering rates, that drives businesses and consumers to open their purse strings. And so you see the Fed funds rate, which is the overnight rate that the Fed controls on the left. And you see, as I mentioned, that's come down 175 basis points from 5.5% to 3.75% over the past couple of years. And the Fed projects that it'll come down 25 basis points for each of the next 2 years. The market thinks a little bit more than that. It's more like two cuts this year rather than one cut. But importantly, the direction is lower for interest rates. And as you can see on the right, um, when the Fed is cutting and there is no recession, because sometimes the Fed cuts because of a recession they see or that's unfolding, then the market can be weak. But when there's no recession, you see the historical average in light blue on the right, the market return is extremely strong. So you could see, 0 to 500 days, a couple years after the first Fed cut in non-recessionary periods in 84, 95, and 98, the market was strong. And much like the previous chart, we're tracking, if you take out that April divot, we're tracking pretty much in line with those returns. And so that bodes well for the future. And I would say it's very different and very much in contrast to the internet bubble, where the Fed was raising rates by 175 basis points, which pricked the bubble and caused the stock market to fall. In this case, the Fed is easing rates. So it's a very different macroeconomic environment, even though a lot of people like to compare the internet bubble with the AI-driven bull market. So taking a step back where we are in this economic expansion, we show on the left various economic expansions over time. Each little diamond that you see on the left is an economic expansion and the year it ended. And you can see that over time, economic expansions have been lasting longer and longer. So as you go out further in time on the X or horizontal axis, the years of expansion increase. There's a few reasons for that. I think there's three main reasons. One, there's a more prominent central bank. I mean, in 1900, the Fed didn't exist. So I think the Fed is certainly helpful there to elongate economic expansions. Two, there's been an economic evolution in this country and around the world, but certainly in this country more so, from manufacturing to services, which I think are less cyclical. So that moderates the economic cycle. And third, improving technology through the use of software. I think we can smooth out a lot of the ups and downs. And so you see on the chart on the left, you see that dark blue dot showing that we're nearly 6 years into this cycle, which historically is pretty far. But when you take into account the fact that expansions have been getting longer over time, and the past three expansions were 9 years, you see that we may indeed have plenty more room. Similar story with the chart on the right, in that the current bull market is only a little over 3 years old. Historically, equities rally for 5 years on average, and the gains are typically significantly stronger than what we've seen so far in this cycle, which began back in October 2022. So the message here is that it's still early. Now, I mentioned that I think business spending is in very good shape, but you can't talk about the economy without talking about consumer spending, because we all know consumers are the majority of economic activity here. Well, I think you may have heard the analogy of the K-shaped economy, in that some consumers are doing well and others are not. And while that's an unfortunate reality, the other part of the reality is that most of the spending is done by the wealthiest quintile or about half the spending is done by the wealthiest quintile in America, and those folks are benefiting from increased net worth, be it housing or stocks, which hit a record high today. You see that their household net worth is up 55% since COVID to about $180 trillion. And there's studies that show that people spend 3% or so of their increase in net worth. So when your net worth goes up 55%, that helps consumer spending significantly. And you can see on the right that consumers are in very good shape from a balance sheet perspective. There we're looking at household debt payments, which includes credit card payments and mortgage payments relative to disposable income. And when consumers are getting tapped out, that ratio rises, which means that consumers really can't spend anymore, have to pay down their debt. And what you see now is that consumers have a lot of headroom relative to history, and that their household debt payments are not onerous relative to their disposable income. So I think they're solid consumer balance sheets and driven by the wealthiest folks among us. So this slide kind of deals with maybe a little bit of a wonky slide in that it gets into some of the details of finance. But for those of you following the stock market and correctly noting that the market is expensive relative to history. I mean, historically, the stock market trades at about 16 to 17 times earnings, we'll say, on a price to earnings multiple basis. And today we're more like 22 times earnings. And that's kept a lot of people, unfortunately, on the sidelines and out of the stock market. And what this slide is trying to argue that the stock market should trade more expensively than it has historically. So what we're saying on the left is that there's a really good relationship between margins, the amount of profit a company earns relative to its revenue. So it's net margin, net profit divided by revenue, is correlated pretty well to its multiple. In other words, the highest margin stocks, quartile 4 in this case on the left chart, is the highest multiple in the stock market, and quartile 1, the lowest margin stocks, are the lowest multiples. So armed with that knowledge, we show you on the right what's been happening over time, in that the net margin for the overall stock market has been increasing significantly. And with that, the price to earnings multiple has been increasing significantly. So today's companies, I'm happy to go into this more if people have questions, but they're far and away much, much better, really much different from a business model perspective, financially, than the leading companies of 20, 30, 40, 50 years ago. And that deserves a higher multiple in our view. So we're not so concerned about valuations, although as you'll see in the bear points, it is something to keep in mind.
So, Brad, we got a couple of questions here.
Okay.
So I guess one question that we're getting through the Q&A is, first one is, what if the Fed does not lower rates?
Yeah, and that's actually a good segue. We didn't plant this question, but it's a good segue to one of the bear cases, which is an inflation resurgence, potential inflation resurgence. If inflation does pick up, then the Fed will not cut as much or at all as it thought, and that would be negative. Although I think it's different than the Fed raising rates significantly, which is what they did in the tech bubble. But yeah, that's definitely a risk. And so let's talk through that. On the left of this chart, you can see core consumer goods inflation has been rising significantly since tariffs were announced. Before tariffs were announced, early 2025, goods were deflating, which is typically what goods have done kind of over the past 10, 20 years because of China, et cetera. But most recently, they've been inflating. Now, not at a super high level, but going from deflation to inflation is significant. So if tariffs continue to add to that inflation, that could put the Fed on hold. And then consumers, who I think have a better handle than probably many people give them credit for, A, and B, it really matters what consumers think for inflation, because inflation is reflexive. The more you think prices will go up, the more you're willing to tolerate higher prices, the more you'll ask for raises, et cetera. And consumers expect significantly higher inflation, as you can see on the right, than they've expected historically. So I think that's a risk. What I would say, though, is that inflation isn't trending higher. It's trending probably lower on net, and that's because services is much more important than goods. So while goods is accelerating significantly, that's only like 20% of CPI. Services is the majority. Actually, housing is probably is more than a third of overall CPI. So housing and then other services like medical, education, business services, those kinds of things. Those are significant inputs, and housing is on the downswing now. And so that's kind of driving overall inflation to stay contained. You're seeing a decent amount of layoffs as well, which is making wage inflation contained as well. So I'm not super worried about it, but I think it makes kind of the top 3 risk factors.
And the Fed's meeting today. They're going to make an announcement later today. It's pretty widely expected that they won't do anything at this, today, but perhaps further this year. And of course, we also have, a new Fed chair coming in at some point this year as well.
Yeah, and a new Fed chair could be, well, we don't know who it's going to be. One would assume that the new Fed chair would be fairly dovish to extremely dovish. That could potentially, I mean, something to keep an eye on. On the face of it, it seems good. It could potentially backfire in that the market may get scared of low short-term rates and actually increase long-term rates. There's some indications in the market that could be the result. And that also is a risk, which we kind of detail a little bit later on in the presentation. That's also a potential risk for equities if long-term rates rise.
Right. All right. One other question that we had on your conversation about the margin increases, margin expansion. How much do you think is due of that is due to the Mag 7?
It's almost all completely due to technology, and most of that is due to the Magnificent Seven. So, on the one hand, people like to cut out the Magnificent Seven. We'll look at the market without that. On the other hand, you're talking about $3 trillion companies. In the case of Nvidia and a couple of the others, and they're very meaningful drivers of earnings and the stock market. So, Nvidia is one of the companies that I had in mind when I talk about these companies are so different. Nvidia has return on assets of well into the double digits, over 40%. To put that in perspective, AT&T, which was a top 10 S&P 500 company from 1930 to 1990, never had a return on assets above 5%. So this is a wildly different economic business model than we had in the past. So yes, I think a lot of it is due to Meta/Facebook, Google, Nvidia, etc. But I think that those are meaningful companies driving earnings and the stock market.
Thank you.
Should I keep going?
Yeah, please.
Okay, I think we skipped just one of the bear points, which is employment. You saw just in the past couple of days today, there was also some announcements. I think Amazon said it was laying off a bunch of people, Pinterest, and there's some others. Consumers and consumer confidence came out weak. Consumers are nervous about the employment market. You see on the right the percentage of jobs, people saying jobs are plentiful, is kind of plummeting. And the employment to population ratio, which I like better because there's a lot of noise in the data. Like I just like the amount of people that there are in the country relative to those who are employed, because otherwise you get into who's looking for work and who's not. And you see that the employment to the population ratio, it's been steady over the past couple of months, but it's been falling generally for the past couple of years. So structurally, the employment market is probably heading to a place where there might be more structurally unemployed people. And I think consumers are sniffing that out and they're not that happy about it. And so that may impact consumer spending. And that is one of my top few bear risks as well. So we have on the bear side, we have the employment weakness, potential inflation resurgence. We mentioned that all this rolls up to potentially cautious consumers, and that consumer confidence is quite low, as you see, and people don't want to commit to buying large household durables, big ticket items like washing machine, dishwashers, those kinds of things. And we mentioned valuations, and you can argue why they should be high, but nonetheless they are high. And history suggests that you shouldn't ignore the fact that valuations are high, whether you look at price to earnings multiples or market capitalization to GDP. There's good reasons for it, but it's still something to keep in mind. And if it does anything, what it does is it probably whenever there is a correction, that correction may be faster and more violent because of the higher valuations. It doesn't mean that the stock market can't go up more. And it doesn't mean that the stock market isn't going to go up over the long term. Both those things can easily be true, but it can impact, I think, the swiftness and depth of a correction. And then the last bear point is really on federal financing and how it relates to long-term government bonds. There have been several instances in the past few years where the bond market vigilantes, as we call them, those who watch inflation and get worried over government finances, push back. And so they did that back in 2022 when a woman named Liz Truss served just 49 days as Britain's prime minister before resigning amid a bond market revolt over her unfunded tax cuts and deregulatory agenda. We saw it also very recently in Japan, where there was significant pushback over the new prime minister's decision to lower the consumption tax. And so today, the U.S. deficit's at a historically high. It's just shy of $2 trillion, which is a little under 6% of GDP, but that's pretty high relative to history. And as the chart on the right shows, the debt held by the public is projected to increase significantly over time, increasing interest expense. I definitely think that chart long term is not sustainable, but I can't tell you when it comes home to roost. All I can tell you is it remains a risk. The good news, and why I don't think it's a risk in the near term, is that there's really no alternative. You're seeing gold becoming, rapidly, I think, a potential alternative for central banks. There's certainly been a flight away from treasury bonds into gold, but gold is not interest bearing, and it's hard to hold a lot of it. I don't think it's going to replace the dollar as a reserve, a store of value. So there has to be a reserve currency that folks use to purchase things from, oil and GPU computer chips that are so much in fashion, and you can't pay for that using gold. So I don't. This doesn't keep me up at night, but I think it's a risk to remember. So when you put all these things together, how does Alger, come out, bullish or bearish? We avoid the question, conveniently for us. The reason why we avoid the question is because we don't think that's the way to make money. We don't think it's a good idea to time the market and figure out whether the market is in a bull phase or a bear phase. What we like to do is find companies and industries that are gaining market share. And so, sure, if the GDP is going to correct and earnings are going to fall, that's probably going to impact all companies. But you always come out of those recessions. And what you really want to do over a full market cycle is to have your portfolio have a larger share of the earnings of an individual economy or the global economy. And so we think all of these industries, like minimally invasive surgery, cloud computing, life science tools, genetic testing, autonomous vehicles, critically generative AI, all of those are in a phase of the S curve where they're going to be able to grow through economic weakness and they'll emerge stronger. We've written a lot about this if you're interested. We have a lot of examples. For example, during the global financial crisis, e-commerce and internet advertising both grew 30% between 2008 and 2011, despite the economy being flat. Same thing happened back in the savings and loan crisis in the early 1990s. PCs grew very significantly through that time frame. So if you can find those areas of the economy that have high growth potential, they should buck the trend and emerge stronger. And so that's essentially what we're trying to do at Alger. And over the past 60 years we've been in business, it's proven pretty favorable for us. So I'll pause there. I think there's other sections in the presentation that we could talk about, particularly long-term investing, which might interest your clients. But we can also get into AI as well, or we could end it.
All right, so we do have a few more questions here. And the first one is relating to AI and the possible changes in the labor force, but isn't AI also leading industry to lay off staff based on the technological improvements?
So far, there's not a lot of indication that AI is leading companies to lay off staff, and the Fed's done many surveys on this, and they continue to do surveys on it. There is some indication that their hiring has been reduced, particularly for young white collar workers, where you're seeing the unemployment rate tick up, and particularly in certain industries like coding, for example. Young software developers are having a tougher time finding a job. I have a feeling that that could move to young financial professionals, having just recently used the Excel plugin for some of this generative AI companies like Anthropic's Claude. So I think you're seeing some reduced hiring aspirations. I don't think you're seeing a lot of outright firings right now, but it's certainly something to watch. And I personally think revenue per employee will be a metric that we talk about a lot more as people try to leverage AI and companies realize that they can get more productivity out of folks.
Yeah, it seems like we're at the point where AI is enhancing the productivity of humans. And as an example, we are now using here at EDW an AI note taker. This AI note taker is saving us a lot of time. It sits in our meetings. It takes the notes for our meetings. We don't have to transcribe the meetings afterwards. It assigns tasks. So it's not causing us to reduce our headcount, but it is making everybody here that much more efficient. And so I think that's where we are with AI at this point. But we are headed to potential labor disruptions as AI gets more powerful and better.
Yeah, and we're doing the same thing at Alger. Normally when I have to shoot a video to tell the kind of the world, our clients what we think, I used to come in, get my makeup done, have a film crew come into the office, record me, and then they would go through the editing, etc. Now many of the videos are done through my AI likeness. So there's no film crew, there's no makeup, and the back office editing is cut, probably 75% or more, and we're saving tens of thousands of dollars on that. And that's just one example.
Yeah. Yeah. Thank you. Let's see. All right. So you talked about tariffs as being a driver of business and a potential tailwind for the markets. Recently, we saw, over the weekend, we saw Europe announce a big trade deal with India. We saw recently Canada announcing a trade deal with China. What is the risk of other countries forming new business relationships that exclude the United States?
I think the risk is low because the U.S. still is such a large market that it can't really be cut out. You can't do business without the U.S., and particularly in very critical industries. And the most obvious one I think right now is AI. Everybody wants those chips that are made essentially in America. America has the largest data center. It's probably 60% of data centers, but critically, most of the equipment that gets made, the most valuable equipment that gets made, gets designed in the United States. Of course, it gets manufactured in other places. Taiwan does most of the manufacturing for the chips. But I think there's increasingly protectionism, and I think AI will be much like nuclear weapons. You don't want other countries to control your nuclear weapons. You don't want other countries to control your AI data centers. So I think there's going to be a lot of talk about sovereign AI and building it out all over the world. But I think the U.S. is too large to simply be cut out, and I think the exports too important.
Thank you. We have two questions on crypto. Where do you see that fitting in, as well as the potential for, maybe that becoming, or some digital currency becoming a world reserve currency?
Well, there's a lot of ways to answer this question. If it's so, crypto and blockchain as a technology, I think has made a lot of progress in the past year for two reasons. Well, starting with the administration's embrace of crypto and moving on to, particularly in the financial markets, the largest, essentially the only clearing corporation in the country has said that they will settle securities digitally on chain, and the NYSE recently said that they would develop a market based on digital assets. So essentially, I think in the future it's pretty clear that securities, whether they be money market funds, which people are experimenting with now, or equities, pick your equity. Those will be digital assets and trade on chain rather than settled to an intermediary like a typical market that we have now. I can explain that more. If you're just asking about Bitcoin, and we have investments that would prosper from that. If you're just asking about Bitcoin as a potential reserve currency, uh, I I would have thought that it would have gained, well, obviously over the past several years, it has gained ground as a store of value. Um, it hasn't made much inroads as a reserve currency or central bank store of value outside of some places like El Salvador and a few other countries. And the recent run up in gold last year, with Bitcoin severely lagging, would say that central banks are not ready to adopt Bitcoin. So that's kind of the summary on Bitcoin as a reserve asset.
So I sat in on a presentation at a conference recently where they talked a lot, where one of the presentations talked a lot about Bitcoin in particular. One of the points that the presenter made, which I found really fascinating, was, in order for something to be a currency, it has to be a stable store of value, right? Bitcoin value fluctuates pretty wildly. So therefore, it is not by definition a currency. It is not a stable store of value. However, what the presenter pointed out is that if you look at currencies across the globe, he pointed out to, I think, like 8 or 10 of them, who the volatility that they were seeing, more than double-digit inflation. The volatility of those currencies was actually greater than that of Bitcoin. And he was specifically pointed out the Turkish lira. At the time, it was Venezuela. There were several currencies. And he said, if you live in one of those countries and that's your currency, Bitcoin is actually a better store of value. So, I always came to this with the eye of an American and looking at it through the US dollar. But if you broaden your perspective a little bit and look at it through the eyes of, someone in another country, it might be a better store of value than your country's currency.
Well, I tried to make that distinction when I was answering the question. So it's not going to be a medium of exchange. You're not going to buy a cup of coffee with Bitcoin because it's too volatile, as you mentioned. And right now it's taxable if you did that. I think they'll solve the tax problem soon, but it's too volatile. What will solve that issue for many people, and I think and the administration said they see this market moving to hundreds of billions of dollars and more, is stablecoins. So a stable coin is the dollar essentially wrapped as a digital asset, and that is stable, pegged to a dollar, and that can be used to purchase things around the world and give people access to dollars who didn't have it before. So as a medium of exchange, I think you're going to see stable coins playing a much larger role. I was just answering Bitcoin relative to kind of a store of value, much like gold, which is obviously volatile as well, and you wouldn't buy a cup of coffee with gold.
Yeah, very good point. Great. All right, so let's see. What industries or sectors would do well if we enter a period of hyperinflation?
We've written about this in the past. The best performing asset class in the 1970s period of, and I don't know if the questioner really means hyperinflation. Hyperinflation is like Weimar Germany. I don't know, gold is the answer to that. But if you just mean a period of high inflation, like the 70s when we went off the gold standard and the oil shocks, et cetera, in the 80s, the best performing assets was small cap stocks did the best. And so, and I think that's because when you have higher inflation, you have higher nominal economic growth, and small caps benefit from economic growth to a greater extent than large caps do as they, leverage some fixed costs and their margins grow.
Um, what about commodities and things like real estate?
Well, the real estate works to the extent that you have fixed debt with termed out for a long duration, and you have inflation escalators. So that would work well. That would the classic case there is like apartment real estate where the cash flows in are floating, with rents that reset every year so that they get the benefit of inflation, but they're financed through long duration debt. And commodities, yeah, of course, commodities would work. We don't love commodities because we don't think that there's a competitive advantage for most commodities, hence their name. When they're kind of just dictated by supply and demand, which can come on at any time. So we're not big players there. We do see a big supply demand imbalance in power in the U.S. and abroad. And for the first time in 60 years, over the past couple of years, we've been overweight independent power producers and utilities, which we've never seen as a growth area before. But that is kind of a commodity area that we're very bullish on.
Really good. So if you have any questions, please go ahead and enter them into the Q&A. You can see at the bottom there of your screen, there is a Q&A button. You're welcome to type them in there. Or as I mentioned earlier, you can email them to info@ebwllc.com. At the moment, we don't have any other questions. Do you have any follow-up comments while we just give it a minute or two to see if more questions come in? Do you have any closing comments?
Well, I think it's important to remember to stay invested over the long term. I mean, I'll put up this one slide. Maybe we'll close with this. Over the long term, stocks track earnings, which you can see on the right. The S&P 500 price since World War II has increased 7% annually, which is just basically in line with what earnings have increased. On top of that, you get dividends, so the return's been a little higher than that. But you can see price tracks earnings, and on the left, you can see that earnings have grown. Those are 10-year rolling periods. They've grown in every single 10-year period since World War II. So if you're a long-term investor, earnings are going to go up. And if you're a fundamental investor, that that stock prices will track those earnings. So over the long term, it's best to stay invested and profit from that huge trend upward in earnings, which ultimately is driven by economic growth. Economic growth is ultimately driven by productivity, and productivity is driven by innovation. And so what we're living through is an acceleration in innovation, which I think stands to reason that productivity will accelerate, the economy will accelerate, earnings growth will be very strong, and that will drive stocks up over the long term.
Very good. So it sounds like you all at Alger are pretty optimistic about the year ahead. We at EBW share that optimism, although we described ours as cautiously optimistic, recognizing that there are some headwinds, as you pointed out. We're some policy uncertainty. We probably will have the Supreme Court, making their decision on whether Trump overstepped constitutional authority in the way that the tariffs were enacted, and that could inject some instability into the markets, at least in the short term. But also recognizing, and of course the labor market is something that we're keeping an eye on, but recognizing that, that AI and business spending and also earnings have been a huge tailwind through 2025 and likely to continue propelling us through 2026. So again, we are cautiously optimistic. So, we share your thoughts as well. So, all right. Well, if that's all, I again thank you all very, very much for joining us today. I hope you found today's presentation helpful. You can always reach out to any of us here at EBW or to your advisor if you have any thoughts, comments, or concerns. We're always happy to talk about these topics with you. I would point you to our website where we just sent out our 2025 year-end wrap-up, as well as our 2026 outlook. So if you have any questions or want to know more about what we are looking at here at EBW, I'd point you there. We also recently sent out a trade notice within the last few weeks that talked about some of the changes that we're making in our portfolio as a result of our evolving outlook. So lots to pay attention to in 2026. Rest assured, we're keeping on top of it, and we'll communicate with you. So thank you all very much for your time. Thank you, Brad. Mike, thank you for bringing Brad to us, and I wish you all a very great day. All right. Thank you all very much. Bye-bye.
Thank you.